Hello, and welcome to CFA Society New York's podcast, Compound Insights. I'm your host, Rob Rowan. Today, we're going to take a close look at research that documents the impact of big data. Our guest is Mariam Farboudi, PhD. Her paper, Where Has All the Data Gone?, is excellent, in my opinion. I would really encourage you to download it now. You could pause the podcast if you like, go to our website where you can find a link to it, or Google it. She's very easy to Google. So Mariam is the John D. Gruber Career Development Professor and an Assistant Professor of Finance at MIT Sloan. Her research focuses on the economics of big data, which we're going to talk about today. Previously, she was an assistant professor at the Benheim Center for Finance at Princeton. She holds a BSc in computer engineering from Sharif University of Technology, an MSc in computer science from the University of Maryland at College Park, and she got her PhD at Booth. So thank you for being here with us today.
Thanks so much for having me.
So I'd like to basically start at the beginning. How did you and your co-authors come up with the concept behind this paper?
So just observationally, collection, processing, and use of data in the finance industry has exploded. We've had prior theoretical research which looked at the effects of this improvement in the technology to process information in the financial sector. And then that creates a headway into for us to think about how the improvement in data processing technology has on the financial sector. Importantly, data is now an important piece of investment decision by the investors. And to understand how investors are using their data, we would first need to measure the data. And that's a very difficult task because data is not measurable and it's not observable. So in order to measure data, we have devised a particular structural model which would help us disentangle data throughout the past couple of decades, where many other things have also changed concurrently. And it has give us information about how investors have been using this superior processing technology in order to inform their investment strategies. We actually do find that unlike what you might have expected, not all the firms have benefited the same way from the improvement in data processing technology. So what this measurement has enabled us to understand how much data have investors processed about different asset classes. And then what we found is that really the improvement in price informativeness of assets have been concentrated in large growth assets. And as data processing power has improved, and basically this big data revolution have not particularly helped price informativeness of smaller firms, and it has even hurt them to some degree.
Right. And there's a part of that is a little bit intuitive or just kind of makes sense to people who've been around the market for a while, because one of the other things that really changed over the term of the data that you're looking at for investment management companies was regulation, which required a lot more due diligence. And that was generally focused on the larger firms as well. These smaller firms don't publish as often, or they can do little. They are audited less stringently. There are other factors that work into that. So I think that from an investment management perspective, that makes a lot of sense. I wonder, how did you, when you looked at the data term, how did you look at the other things that were affecting the price informativeness over that period, including the regulation and other things like exceptionally low rates, et cetera?
So you're exactly pinpointing the key to this paper, which is price informativeness, which is basically how much prices move with the fundamentals of the firm, is affected by many factors. And many of these factors, including regulation, have changed over the past couple of decades. What we do find first order is that the price informativeness of large growth firms have increased over time, while the price informativeness of the other groups of firms have stagnated. Mm-hmm. Now, it's very logical to try to associate this improvement of price informativeness to other forces than investor data accumulation and processing. So what we have done is that we have devised a structural model which takes care of these different parts. And it basically shows us that the price informativeness of a class of assets, for us, a particular groups of firm, consists of different pieces. It consists of a volatility component, which of course regulation heavily affects the volatility component. It consists of a growth component that both incorporates the future growth prospects of the firm internally, as well as how it is affected by regulation. And third, it is affected by the amount of data that investors choose to process about this asset. Investors processing data about this asset makes the prices more informative, ceteris paribus, because basically more information is built into prices. Mm-hmm. So, but it's to understand whether this improvement in price informativeness comes from investors' data processing or from the other components of volatility and growth requires us to measure this data separately than the other two measures. Okay. So in order to do this task, what we do is that we use relatively straightforward regression analysis to first find the price informativeness of 4 different groups of firms. In particular, we group all the listed firms into large growth, small growth, large value, and small value firms. And for each group, separately, we estimate the price informativeness over 5 decades. Then we again go back to the data and directly from the data measure volatility of both prices and firm fundamentals. For instance, think about it as earnings, EBIT of the firm, as well as the growth component. And then the residual tells us what the information that is acquired by the investors is. Then once we do this analysis, the really interesting observation is that the price informativeness, as I have mentioned, has trended upward for large growth firms, but for the rest of the firms, it has completely stagnated. Mm-hmm. Volatility has been going up and down, but again, on average, it's constant for each group of firms. And then, in fact, the growth components have even declined for the large growth firms. So you would have thought that it contributes negatively to the price informativeness.
Right.
However, the data that investors have collected about the large growth firm is so much that it has more than compensated and has led to this improvement in price informativeness.
Yeah, so that was actually the part of your paper that I thought was less intuitive and also quite fascinating. It was just the volume overcame that part of it.
That's
To anyone who's listening to this podcast, also, Mariam wasn't kidding. The regression analysis is things that probably almost everyone's firm has used before. So you don't be afraid of the math. You get a couple of pages in, the math gets a little scary, but that part pretty easy. So that's a lot about what the data tells us. Are there things that you saw in the data that it doesn't tell us? Other questions that came to you in your co-authors while you were doing this?
So it gives us a million questions to think about. One of the most important ones that now we're pursuing is thinking about the value of data. Mm-hmm. Because data is so difficult to measure because it's not observable. It's also extremely difficult to put a value on it. And what is very, very fascinating is that right now, a lot of the largest firms in the US stock market are primarily valued for their data, because data is an asset. But it's extremely hard to value, one, because there is not a centralized market to transact data. Second, a lot of the data that the firms produce is the byproduct of their transactions. So it is not even recorded in their balance sheet, and that makes it even more difficult. Furthermore, in a lot of the data is publicly available. Investors do different investments to try to collect data about their firms. They try to observe supply noise. Different types of investors try to capture different data series to understand the data about these firms. And these are all done not in a concentrated way. And all of that makes us believe that data, we don't have really good measures of value of data. And that is extremely important for regulation. There's all sort of regulation being discussed right now in the financial sector and in the real economy to try to regulate data markets, data acquisition from consumers, how firms can release data, so on and so forth. And in order to optimally devise regulation, we definitely need to understand the value of data better.
Right. There's also the other partner to how the data is valued is what they do with it. That's the other part.
Oh, exactly. So that is, sorry, I totally missed this point, which is extremely important. So data can be used very heavily for monopolistic behavior, to get monopolistic rents, and being used against either customer or other firms. Okay. Or it can be used to improve quality of products, quality of investment. It can be used to divert investor financing to better firms, or it can be used to price discriminate against firms. And so that is exactly as you go. It's very important to understand what data is being used for.
Right. And one thing I just want to point out, it sounded like when you said monopolistic rents, you were talking about that in terms of economics, not in terms of rental
spaces. Yes, I should say non-competitive behavior.
Non-competitive behavior is not
can be used by for firms non-competitively to, for instance, prevent other firms from entering the market. Okay. Mm-hmm. Or it can be used for very positive things of like improving the quality of their products.
Right.
And in order to understand and measure all of these, we need to be able to measure data. And this paper is really just a first step to try to measure data in a particular setting of price informativeness and investor behavior in the financial markets, because that is a market in which investor behavior is relatively well understood, and we have kind of relatively good frameworks to think about this question.
Right, and there's lots of other data you can use to verify it. So what do you think is next for you in your research on this topic?
So one question that I've received very, very often is exactly the point that you raised of how data is being used by investors and by firms.
Mm-hmm.
Is it being used by firms to improve their product quality, or is it being used to price discriminate against customers? A good example, which will be regulated when it comes to is insurance companies.
Yes.
If you want, as a firm, if the purpose is to provide risk sharing, that means you should not condition on the data about customers. And that is part of the reason that a lot of insurance products are not allowed to do this conditioning. But at the same time, there are benefits to in general other businesses to conditioning on the data. And there is like a very fine line between when price discrimination hurts risk sharing versus when data helps improvement of services.
That will be fascinating. I'm sure all of us are going to be real interested in that.
And the other thing that we are thinking about is how investors use their prices. For instance, if you think about financing, there is huge evidence that firm distribution is becoming more skewed. Big firms get bigger and small firms stagnate. Okay.
Right.
And then the observation that we made, which is kind of not so happy, is that this growth of the ability to process data do contribute to this fattening of the tail of the large firms. Okay. Why? Because investors are willing to lend firms at more favorable rates when they can assess their risk better.
Right.
Larger firms are also older firms, so there's more data available about them. Mm-hmm. So investors are able to better assess them. So they give a lot of funding is going toward larger firms who get larger. And so smaller firms are going to stagnate.
Okay.
And so that is one part that regulation can be helpful in providing safety nets, I'm not a regulation expert, so I'm definitely not in position to decide on a good regulation, but that is something that regulators should have in mind, that data disproportionately helps larger firms. And to the extent that you would like to motivate small firm entry, there is some need to regulate, to create useful regulation about data.
Well said. Well said. Well, thank you. That one thing you were just mentioning about the insurance companies made me think for everyone who got hooked onto that topic as well. In 3 weeks, we will have on the podcast Bill Puziaka, who is the former CIO of AIG. And he has some thoughts about the impact of the generation of separate insurance management groups that manage the assets and their trend towards more outsourcing and the impact that has on the market as a whole. So if anyone was interested in what Mariam just said, please tune into that podcast in the future, because that'll also be really interesting to you. So thank you, Mariam. Once again, to the people who are here, please read her study. It is really good. It's also very accessible. It's not the hardest one I've ever suggested to anybody. So it's called Where Has All the Data Gone? And thank you very much for being here.
Thanks so much, Robert. It was amazing.